Looking to take your financial knowledge to the next level? You're in the right place. Welcome to Ask Ralph, offering accounting, technical, and financial advice. Whether you're looking to save taxes or improve your business, he's got you covered. Here's your host of Ask Ralph, Ralph Eastep Jr.
Hello and welcome back to the Ask Ralph Show. My name is Ralph Eastep Jr. and I own an accounting practice in Middletown, Delaware. I do this radio show every week, and I also release a podcast which you can get from your typical place that you get podcasts, which could be the iTunes Store or Google Play or any of the other typical podcast locations. My sidekick, Caroline, who works in my office, sort of handles that for me, and I also want to give her some props, if you will. She does a lot of stuff for the show. And then Taylor has been a great asset to me as well. She works for me as well. And she really helps build a lot of the repertoire of what goes on to our website and also a lot of the content that goes into the show. So I want to thank both of those ladies because they really make the Ask Ralph Show possible. Well, today what I thought I'd talk about is something that will be very cool if you own a home and you have a mortgage. And that is 4 ways to pay off your mortgage early. If you pay off your mortgage early, see, there's a benefit to this. You could save a lot of money on interest. That's really the key here. Once you own your home, then you can take what you were spending on your mortgage payments and put them towards other important accounts, like saving for retirement, a college education for your child, or put them in your emergency fund. So how do you do this? And I have a lot of clients that ask me this, and I've coached a lot of clients over the years. And I have seen huge success in this if you're willing to put in the time to make it work. The first thing that you can really do is refinance to a shorter term loan. I know a lot of people will say, Ralph, are you kidding me? We talked about that with the mortgage broker. We talked about that with the mortgage company. And, I just don't think I can swing those payments. But you really should consider it. And that is if you have a 30-year loan, you can refinance to a 10 or 15-year loan. The key to this is you're going to pay off the loan in a fraction of the time. So let's give you a real life example. So let's say you got a 30-year fixed rate mortgage for $200,000 at 4.5%. All right. 5 years later, you refinance it into a 15-year loan at 4%. This pays off the mortgage 10 years earlier. And this is the key. That 0.5% and a 15-year loan is going to save you $60,000 in interest. That's a lot of money, my friends. And the truth is, the shorter term loans tend to have lower interest rates, and that's all about interest rate risk. And I don't want to spend a whole lot of time talking about that, but you got to understand something. A lender is lending you money on a 30-year fixed rate mortgage based on today's current economic climate. Well, if the economic climate changes drastically, like let's say we get back into a period like we had in the early 80s or, more like the late 70s into the early 80s when we had double-digit inflation and interest rates were skyrocketing. Well, if you had a 3 or 4% 30-year fixed rate mortgage rate, then oh boy, the banks were dying because they weren't making any money on those loans compared to what they were having to pay out to keep money in the bank. So that's the first thing. Now, second thing you can consider is pay a little more every month. It's a couple of different ways to do that. One way is divide your monthly payments, principal and interest by 12, and then add that amount to your monthly payment for a year. So what am I saying here? So basically, let's say your payment, is $1,200 a month. That'll make it real simple. Take that $1,200, divide by 12, you get $100. So you would add $100 to your monthly payment. So you effectively make 13 payments in the time period when you would only make 12. So let's talk about an example of this. So a $200,000 mortgage at 4.5%. After 5 years of making the minimum payments, you add an extra 1/12, as we talked about, of a month's principal and interest to each monthly payment. This pays off your mortgage 3 years and 3 months earlier and saves more than $18,000 in interest. So what are you effectively doing? One extra payment a year. You pay a little bit each time, divided by each of the payments. It's going to save you 3 years, 3 months on the loan, and $18,000. Now, it's a little bit of a catch to this. And the mortgage companies are wise to this. So you want to make sure you talk to your mortgage servicer, the person that actually services your mortgage, and understand what you need to do to get them to post those extra payments towards the loan. In some cases, they'll just apply it as a next payment and they don't post the actual payment at the time. Now, the other thing that you could look at doing is biweekly payments. But again, make sure that you talk to your lender and you understand exactly when they're going to be posting these payments, because you might make 2 payments a month, but if they only post it once a month, it's really not helping you at all. The third thing you can do is make 1 extra mortgage payment each year. So this is the converse to adding a little bit more to each payment. You could just say, instead of paying a little bit more each month, make 1 extra monthly payment each year. One way to do this is you put that 1/12 aside and then just put it in account and save it. Here's another example of that. So let's say you do this starting the first month after getting a 30-year mortgage for $200,000 at 4.5%. That would save more than $27,000 in interest, and you would pay the loan off 4 years and 3 months earlier. So you see the big impact of this. The other thing you can do is just try to do what you can to throw every little bit of extra money that you can find towards your mortgage. That could be simple as, if you get a bonus at work, you say, okay, I'm just automatically put that against my mortgage. You could use your annual tax refund for that. Let's say you inherit money, rather than going and buying a brand new sports car, put that money against your mortgage. Let's say you have a side business. You might look at using a side business to pay down your mortgage, or, a lot of clients will do this, and that's if they get a raise, whatever the amount of their raise is, they make that their extra mortgage payments on a monthly basis. So what's the impact of that? Let's say you have a 30-year fixed rate mortgage for $200,000 at 4.5%. 5 years into it, you pay an extra $10,000 in a lump sum. Just $10,000, okay? This pays off the mortgage 2 years and 4 months early and saves more than $19,000 in interest. Of course, the downside to that, it makes it more difficult to predict the mortgage payoff date. And you have to be careful, that you still got your emergency fund, because you want to be mindful of not putting so much extra cash toward the mortgage that it comes out of other obligations. I've had clients that have done things like, well, I'm really working on paying off my mortgage, but, I've been noticing I'm running up a credit card balance. Well, you got to think about in terms of, what's the most financially best way to handle things. If your mortgage rate is only 4.5% plus it's tax deductible, but you're paying an 18% credit card, well, it doesn't take a rocket scientist to figure out that you need to pay that credit card off first. I mean, the idea of paying off your mortgage is great, but you've got to look at, what is the most financially advantageous thing to do. And, and that's where it pays to sit down with somebody like myself, or an accountant, and just kind of go over your finances. So many people don't do that with a professional. And, we can really sit down together and, take a look at your budget and say, where can we save some money? I had a client a few years back that we sat down and did that, and they ended up paying off their 30-year mortgage in 10 years. And they come back and see me every year. They rave about, how I really helped them. Well, they helped themselves. I was able to give them a sort of a roadmap on how to make it work. But in the end, they did it themselves. And that's what it takes, a discipline. That's what this all comes down to. You can keep the 30-year mortgage and just make extra payments. But a lot of people just don't have the discipline to do that. So I hope this was helpful, talking about 4 ways to pay off your mortgage early and get that interest albatross away from you.
You've been listening to Ask Ralph, brought to you by Sazio Accounting Plus. Please subscribe to and rate our podcast on Apple Podcasts or wherever you get your podcasts, and leave us a rating and review. Our podcast is produced by Carolyn Peters. Thank you for listening, and be sure to like us on Facebook and follow us on Twitter at Ask Ralph Media. You can also hear me each week on 1450 WILM and on 1410 WDOV in Delaware, and on the iHeartRadio app. Submit your questions or ideas for future shows by sending an email to AskRalph@AskRalph.com.
The information contained in this episode of Ask Ralph is based on data available as of the date of its release. Sazio Accounting Plus and Ask Ralph Media Inc. is under no obligation to update this content if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances, and any information provided is not to be considered as financial, tax, or legal advice. Please consult your tax advisor or attorney before acting on any material covered.